Yeah, there we go. We're in.
Excellent, excellent. Well, everybody, here we are on another Thursday night, and I'm sure we'll have some other people join us in the next few minutes as well, but we're going to get started. We're here again with John Atwell, the Rogue Trader, and people have put some questions into the questions for Rogue Channel. So John's going to get started by answering a couple of the questions that he checked out ahead of time. And then we'll just see where the conversation goes. We're planning to go until 7 o'clock, so just for an hour. So John, take it away.
Well, the first one I wanted to address was sent to me a few days ago from Z, asking if I could ask my prime broker to remove the restraining order against him. So it was a pure coincidence. I was in the bathroom stall with your rep, is what Z writes. And, things happen like that. Prime brokers, keep a tight leash on them. That's all I can say. Because they'll try to get away with hell if they can. And so the only question, there's one that Wisco put in. Let's see, is Wisco here yet? No, let's wait till he gets here. And another one is from Tani. So Rich, let's wait on those because they're not. I don't see them here yet.
Well, do you want to start talking then, John, about some pit experiences and maybe talk about that snafu of a couple of mornings ago?
Let's talk a little bit pit, and we can certainly talk about that obviously a virus situation the other day, and then I've got a few things that I've picked out for us all to look at that I can illustrate some principles that I from observing everyone in the room I think needs to hear. So to the pit, literally, I find it rather sad that the pits are gone. It just took such a human element out of it, and I really did enjoy it, despite it being. Being in the pits was very physical, and it got more physical as I changed pits. I started off in the soybean pit, which was, decently large, but not the size of the Treasury bond pit and then the S&P pit. So that was a good learning place, simply because, first of all, you're trading one instrument, so you damn well know where you've got to know where the major points are, and you also had a huge edge because you knew who the guys were, and this applies to all these pits. It just gets a little more difficult the bigger the pit. You knew the guys that had big orders, that really move size for institutions that would move the market, and really, just taking it forward to how it is now. It's still today. It's all the big orders that move things. Hundreds of lots, not tens, 20s, etc. So that was one wonderful thing about the pit, is understanding who was who. If guy had an Archer Daniels Midland badge on an ADM, you might want to pay attention to him. And even back in the day, Merrill Lynch ran huge commodity orders, and so that was really an advantage that has gone away now. And then I moved over to the bond pit, still at the Chicago Board of Trade, and that was a much bigger, really right as that market just became interest rates used to just be this thing that the Federal Reserve and the big banks set the rate, and that was that. And now you had a market setting the rates, and it was it was like being on the new frontier, because literally being in a market in the pit where all the paper's coming through on what was then a new frontier was just a wonderful experience. And one of the things that was great for me was, given that I had experience in the soybean pit and had been successful at it, in a lot of ways, I knew more about what to look for and what to do than the guys that were running the really big orders for the big banks, et cetera, and who was fronting for people like the U.S. Treasury, et cetera, the Federal Reserve. They're in there. Anybody who doesn't think that they're in there manipulating. So if you know who the Federal Reserve guy is, and you just start to see him lift his hands up in a sell way, because palms out is sell, palms in is buy. If you were long, you dumped it as fast as you could before he could say a word. So there were real edges in there that were less of these technical things and much more human. We've lost a lot of that in the market now. And then really the S&P pit, and that was that again, another new frontier when that got jump started. I mean, you just want to talk about insanity and physicality. At the end of the day, you literally went to went over to your clearing broker, and your clearing broker handed you all your fines that the exchange had given them for fighting that day. Because there wasn't a day that you didn't get punched or give a punch, and usually multiples. So anyway, so I'll answer any specific questions, but that's just kind of a general view that it appeared, if you were in the visitor gallery, or if you see a movie with a trading pit in it, it looks like it's absolute mayhem. But once you understood the order, everything became very clear, and that principle, by the way, definitely applies to each and every one of your trading. Is once you understand the principles that you are trading by, market action starts to make a lot more sense. And so, I think that my floor experience trained me very well for my off floor experience, simply because, it instilled in me a sense that don't observe things before you get involved with them, if that makes sense, guys.
It does. John, while you're on the topic of the pit, just tell us a story about the one day you remember more than any other when all hell broke loose.
Oh, well, that was, October 19th, 1987. Yeah, very, very hard to forget. That was the crash. And that was certainly the first crash that ever happened in which there were futures markets running things. And, literally the market had been going relentlessly down the week before, just down, 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 and you could get a real sense of fear, but you didn't get a sense of the fear crescendo, until that Monday, and whoever the big institutional guys were that literally decided to just hedge or dump everything. They got that going pretty early in the morning, and one thing that gave you another edge is and obviously this is a much more general than specific thing, but having a general idea of what big guys counts were in terms of like how much paper have they sold, what is their position, what was their position, etc. And it became clear to me very early in the day, and several of my buddies who just like we have the misfit room. You had your posse, and we had each other's back and exchanged information, and we were all over on the same side of the pit, about 2 steps up from the middle, and literally we just looked at it. It's like, no, that's not a hedge. That's Goldman over there. They're going short, and they're shorting the shit out of it. And everybody still thinks it's a hedge, and so you see that, and you just go short, sell everything you can, and at that point, that day, now I had firms that I had that I had deals with, that I would handle some of their paper occasionally. And that day, it was just like, I'm not handling any paper. I'm just trading. This is the day I'm trading for me. And the thing is me. I always say, always be scaling. Kind of that day was almost always be pressing. I mean, literally every minor uptick was just, you just shorted more, and the one of the funny aspects of it is, you do have a broker that guarantees your trades. Everybody has to have one that in effect that clears your trades for you, and in return, you've got to keep a certain minimum amount of capital up, which in effect represents, in a loose sense, it's not quite what it means now, but it's your margin. And I and my buddies, we were paid no attention to our size at all, and so literally at the end of the day, and I mean that day, just it was, literally the funny thing was watching the guys that kept trying to buy it. They're like, it can't go down more than this, because it's never done this. And when they say never, they're talking about in modern times. It certainly did this, but there were no futures markets back in the 29 crash, etc. But so they were using that as an excuse to buy, and guys literally got carried out in body bags. There were guys that after that day, you never saw them in the exchange again. You might see them. You might see them in a bar. Absolutely keeled over the bar. But they were tapped out. But the thing about just that day at the end is, I and a bunch of other guys, we had way exceeded the risk that in effect our clearing broker at least knowingly took with us. And but again, it's the human factor, because there's a lot more trust, because now you can just use computers just to cut somebody off. And so at the end of the day, it was after the utter carnage, and then you just kind of went over to the clearing booth, and back then I was clearing through a firm named Stotler that doesn't exist anymore, and they said that came in. I hand, and you're handing cards back to clerks, right? And they're running them in and time stamping. So, they do have some rough idea where you are, but they also have an idea of whether you're profitable or not. And so literally, I got over to the Stotler desk, and it was like, gave them my last cards, and they were like, John, could you wait here? Howard and Robert Stotler want to talk to you. So they called up, said he's here. Get on the phone, and they're like, well, buddy, you went a little over your skis today, did you? And I'm like, yeah. And he's like, yeah. And you made an awful lot of money, it seems. And I'm like, yeah. And so anyway, their angle was, and I got it. They're like, so we were technically at risk, weren't we? And so at the end of the day, I ended up disgorging 40% of the profits I earned that day to Stotler. And I was quite happy with that, trust me. Yeah, and at that number, they were quite generous. So, but those are the kind of things that could happen in a pit that just, unfortunately, we've lost that now.
Thank you. So why don't we grab this question from Dan? You just talked about a great day. He asked, how do you recover from a mistake or bad trades? What does the rogue post-mortem process look like?
Okay, so this goes to, even more broader than that question, because that's a very good question. Because there's a day in which there's a bullet with your name on it, and it doesn't matter who you are. So first of all, don't feel bad about that, and don't judge yourself. The first thing is, when something like that happens, is I would say to myself, did I stick with my process? Did I stay inside my rule set? And if that's the case, then first of all, you did nothing wrong. It's just a result that literally, let's say, a bad day, for instance, could be, for instance, especially in a much more of a pit setting, but this just applies as much to screen trading now. You might be trading a process that wins 70% of the time, and so you're winning 7 out of 10 times, but out of a large sample of trades, let's just use an easy number like 1,000. In a 70% process, that doesn't tell you that there's not 40 or 50 trades in a row that you lose money on pursuing that process. And so that brings up the concept of what I call maximum adverse excursion. Now, if you actually are trading a system per se, I mean, a one that just literally the computer buys, it tells you when to buy, when to sell, etc. If you do not know what your system's maximum adverse excursion is, then you have a mathematical bomb waiting to go off on you. So that's a very important part. Now, in terms of process, I consider myself. I do have some systems that trade stuff that I literally pay no attention to. But otherwise, I would consider myself a opportunistic process trader. And the thing that I have that a lot of you guys don't is simply I have data from trading for 40 years. So I actually kind of know myself very well, and I know even in my process, like, okay, hey, I've lost 7 times in a row. This is just normal. And so, Rich, to really get into the nitty gritty of your question is how do you come back? Well, and this is another concept of trade sizing. First of all, the get well quick trade doesn't work. That's when you go tapioca. I've seen that too many times. So, basically, the way I look at my capital base is that I've got, I'm going to size based on where I'm at. If I'm in a drawdown, I'm automatically lowering my size. And then as I get hot, I'm actually increasing my size. And so, really the answer is you start by trading small. Yeah. You start back by trading small. And number one, that's mathematically a very good thing. But second of all, it takes the pressure off of you because okay, if I lose on this one, I'm not going to lose a lot. Because if you get that's what I call the Chinese finger trap whole setup. The Chinese finger trap is one of those things that the harder you pull, the stucker you are. And so it gets you out of the Chinese finger trap, and allows you just to start regaining the confidence in your process, which does work over time, and build your size as you build your equity.
That's helpful, John. And you and I have talked a lot about tennis, and I like to relate things in different parts of my life back to maybe more familiar and more basic concepts. When we were working in tennis with my daughter, who was a nationally ranked player, as you were, she had a coach, and he worked more on psychology, really, than on strokes.
Was that at Nick's place?
No, that was at Naples Bath and Tennis.
Oh, got it.
And no, I told you how she walked out on Nick at 10 years old.
I was going to say that all you got at Nick's was abuse.
No. Nick went to the bathroom, and she said, "Dad, this guy's an asshole at 10 years old. Let's go." But this other coach, he related a lot of stuff to skiing, and he said, when you've made a bad shot, or if you have a series of bad shots, the best thing to do is go back to the bunny slope, because that's where you get your confidence back. You know that you can do those basic things. You just need to give yourself that confidence back then, so you can get on the more difficult terrain and really go after it.
I love the bunny slope analogy, Rich, because truly, the get well quick trade never works. The bunny slope works. It builds confidence again, and you're not going to get hurt badly when you fall.
No. So Scoob had a great question from last time, and he said there are thousands of stocks, hundreds of times of even more chart permutations, depending on time frames, that a person can scan. And last time in our session, you walked us through the thought process that you had for the SLB trade, including what you saw as the setup before you executed. We remember you saying it all starts from the daily chart, but given there's such a deluge of information, what's your process for identifying these setups? What is the process that you use for scanning for the right charts to execute to begin with? And do you look at daily charts for stocks in hot sectors, or have a running short list that you've saved? And is there a way to streamline that scanning, since it's often hard as executing the trade itself?
So great question, Rich. And now, I mean, you guys come in and there's so many scanners that can generate all kinds of things. And I just don't use them, but I'm also 64 years old and have been in this for a long ass time. And I have a process that works for me.
You're a geezer.
Yeah, I am a geezer. That's I'm a geezer that's had 2 open heart surgeries and a stroke. So this is what you get in the life of a trader. But all kidding aside, so literally for me, I keep a short list. I'm looking at it here. There's probably maybe 40 stocks in it, and they all meet my criteria. And now, by the way, this is a happy problem to have. That there's enough liquidity to where and I have to say, I used to say to where I don't move the market. Now I just have my standard is I don't move the market much. Because there's some of these OTC things that if I put bids in for the size I want, I mean, either A, they're going to fill me because they want to fuck me, because they have stuff they want to get rid of, or and then believe me, as soon as if I ever see that happen, I immediately turn around and dump it. I mean, it's just that's just tape reading 101. But otherwise, you have to start getting clever and disguise your orders. Use multiple brokers, etc., so that they don't get a sense that there's that somebody's accumulating, or at least not in size.
And we see that when you something and you're right now. So we'll see that here using 10 and 11.
All right, so why don't we open it up for some folks to actually just ask some live questions?
Yeah, ask some questions, and then Rich, I've got I don't know, 6 or 7 charts that I want to have everybody pull up that I want to use just for illustrative purposes.
Sounds great. So anybody just jump in and ask.
Mm-hmm.
But let me start with a question that Tani sent me, and just asked if I would expand a little bit on something I said. Another trick: put in an order between the current bid and ask at a limit. If the limit doesn't fill in 1 minute or less, cancel the order and then buy sell at the market. So that's just again. I'm an old school tape reader, and the truth is, and when I take you through the patterns, you'll see the way that markets are delivered to us has changed, but markets themselves have not, with the exception of literally that craziness that happened on the open 2 days ago, where it's clearly computers gone mad. But the idea is that by putting something in the let's say I want to buy 100,000 shares of something. If I throw out an order, let's say it's at 2650 at 2653 or something like that, and I'll put an order in for 10 at say 61. So that's in the middle of a 3-cent spread, and I get filled immediately. That literally, I turn around and I just toss that, because if I get filled too fast, it's not good. The truth of the matter is, and this is a hard one to get through our skulls, is that when you get a bad fill, I mean, as the word is used, slippage. Let's say you're just, for instance, say you're buying something, and it was, bid 2650, ask 2652, and
Hello.
and they fill and they fill you at 2655. You think, oh, I got screwed, and you're like, oh no, man, there's a bid in this thing.
I'll just leave. Never mind. Never mind. This is live. I can't fuck around. I'm sorry. I thought I could sit here for 15 minutes.
That's okay.
Taco's mic is hot.
We have a hot mic. There we go. Sorry, John. I think we lost you for a moment there.
Do you have me now?
We do.
Okay. So sorry, there was a bunch of crosstalk over me, so it's not that clear what was going on.
Oh, shut up. I'm kidding you.
Well, fuck you too.
On a good day.
All right, who am I talking to here?
So do you need a question, or did you want to put up some charts now?
No, well, no, I thought there was a question, but anyway, apparently not. So one thing, Taco is back now. He had some stuff to attend to, but he's gonna put up some charts if you guys can see them. And so the first one that I wanted to bring up was a crude oil contract, a crude oil continuous contract. That's probably the easiest thing to look at. And it just, it's an illustration, and just do it on a daily.
Yep, we're good. I got you.
Okay. So, I can't tell you how many times people say the market's changed and old things don't work, and it's just not true. They may not work. One of the things that I see from guys in the room is not knowing the time frame that they're trading in. In fact, there's in the long run, there's far too much quick trading for anybody to succeed. You're even though commissions are low now, you're still churning yourself to death, and you can't make that many decisions in a day, and expect to get paid over the long run. So that's number one. That's my dad's lecture today. Is a lot of you guys are over trading, and over trading, brokers love it. Your bottom line, not so much. There's a quote, I think, from the Reminiscences of the Stock Operator about Jesse Livermore. The big money is in the big move, and pretty hard to pick up a big move on a 5-minute chart consistently. It's much the longer time horizon that you're at least using to lead yourself to a trade and lead yourself to a lean on the trade. Am I buying? And in the case of options, am I buying calls? Am I buying puts? Which direction am I betting? So I prefer a real top-down process. So if you look at a crude oil chart, first of all, I just have two time periods to look at in which I can show you classic pattern still exists. So September, if you look at oil on a daily in September, in early September, you made and this is an inverse Head and Shoulders. You made a shoulder in early September. You made a head in late September, and you made a shoulder in kind of middish October. So I see that, and I see the high of the day taken out of that bar, which is October 18th. I see the high of that bar taken out. So now the shoulder's in. So I'm my bias at that point is to trade in any time frame, to trade crude from the long side. And it wasn't a huge move, but it was certainly profitable. And so that pattern still exists. And then literally recently, starting in late November, with a shoulder on again an inverse shoulder, then on the let's see, that's December 9th, you put in a low, which ended up making it a head, and then literally here in early January, you put it.
Jim, thank you.
Great,
look. Really it. Oh my God. Is my mic on? Oh my Lord.
Did he cut out for everybody or just me?
I don't hear him either. You there, John?
Yeah, I'm here. I just got all kinds of static came over, and I get it. Believe me, managing our mics is not easy. So anyway, I mean, if you've got the daily charter, you can clearly see in
I've got it pulled up for you.
Yeah,
I can see it.
Okay. Early this month, you had you had the right side shoulder inverse, and so now your bias has been up. I mean, again, it hasn't been a huge move, but if you guys who are short term trading, and this applies to any market, are doing your shorter term trades in sync with the longer term dominant pattern, you will find much more success, because when long-term patterns, when they assert themselves, I mean, they just move markets hugely. So you're at least opening up with a bias towards that can happen for you. I am, and look, I've known some very successful counter trend traders but that was pit stuff. They read people, and the thing, and what we're in now, you're not really able to read people like you could in a pit. And so, my default mode and certainly my is to absolutely be aligned with the bigger pattern. So anyway, so that crude oil is just an illustration that inverse Head and Shoulders still exist, and you should be aware of it, because the one thing that charts reflect is human behavior. Yes, everything's in the cloud now, in the Borg, in the computer, but human behavior hasn't changed for centuries, and isn't changing. The fear, greed, it still exists in every one of us in the exact same form it always has.
That's the basis of the dominoes play too, John. Inverse Head and Shoulders clearly formed in May, October, and then in January of this year.
Exactly.
And it's shown quite clearly, and I think Jim Bowman picked up on that.
Yes, I mean you got that kind of second week of this month. You got that candle which represents a head, and I posted the trades. I mean, that's why I got involved on the long side with DPZ. So, plain and simple. I didn't think anything more through it.
Yeah, there it is, right there.
Uh,
Can everybody see the charts? If you can't, you need to just click on live stream.
I have dominoes pulled up right now. Not sure if you want to change it to your next chart on your list.
So the next chart on my list is K-Web. Now, K-Web, one of these crazy ass Chinese indexes, but just notice how orderly it has been off the lows. You thrust up, consolidate, thrust up, consolidate, thrust up, and now today you broke out more. Now there's a couple of things to learn from this chart. Number one is that once there is what I'll call a tendency or an ism about a chart, you can make a lot of money just betting on that is going to continue to happen again and again until it doesn't. If you've scaled and you've made 30 trades in it, that when it finally changes, it's not going to hurt you much, and you banked a lot of money. And so literally off the lows, K-Web, which is just kind of represents China in general, has thrust up, consolidated, thrust up, consolidated, and now today we started yet another thrust up. And one of the things, and this trade, of course, obviously is a long bias that somebody needs to know that's important is that there are shorts not only in K-Web, but I'm sure in all of the underlying stocks of it. And the further along a pattern gets, actually, the more it's going to move because these guys are taking real heat. Now, a lot of times moves are made, and we've seen some crazy stuff in some of these $1 tickers or whatever. But forget that. But that's still like a piece of news comes out, and by God, everybody has to cover their short, and there's nowhere to go. I mean, literally, it's the game where everybody stands up and you take one chair back, and then when the music stops, everybody sits down, but one person doesn't have a chair, and they're losing their chair. So what happens is the further along you get in the move, and this is true up and down. The actual speed of the move in the direction that the patterns are showing you increases. And if you look at how K-Web made a low, and it made its ultimate low here on October 24th, and it had been relentlessly going down for about 2 months, and then finally it just had a huge gap down that put in a spike bottom. But that's where you make the big money is being in there when that happens. Now, can you predict and say what day it is? No. Forget predicting. But just you've just got to go. It's like going to the hot table in Vegas. You've got to go somewhere, be in things where good things can happen to you, and be aligned with that. Be aligned with the greater forces, even in your shorter term trading. So the next chart that I had with set up here with Taco, just something I wanted you guys to look at was the IWN, the Russell 2000.
Got it pulled up. We're good.
Okay, so just notice that literally going back to November and then literally right at the 1st of December, we're right up about this 150 level, and now we're approaching it a third time. I'll tell you this: there are such things as double tops, and certainly the double top. Once it established that it was a double top, and basically the way I'll define that is that you had that second high, which was indeed on the first of December. Once you took out that low, and then I keep things very simple. I over time there's 3 moving averages I use on daily charts. There's a 200-day moving average, a 50-day moving average, and a 10-day moving average, and they're all simple moving averages. So certainly the double top paid off. I mean, basically you went up there and then you closed 2 days later well underneath the 200-day moving average. So your bias on this has got to be short, and that even worked on a day when it spiked up and just got rejected. You've got to get to where in a particular market, I'm either long only this market or short only this market, and that's that, because it gives you clarity. And I know a lot of you guys are short-term trading, and that's and whether that's based on your capital base or whatever, that's fine. But the idea that you're examining something for 2 directions in a day is, I'm just telling you, it messes with your mind even if you don't know it. So come to the present day on IWM, you're right under 150. These highs kind of have centered around the high 150 area. There's just basically, I mean, with incredibly rare exception, no such thing as a triple top. So if right now it's making a very nice, you could call it a bull flag or a bull wedge. I'm just telling you that if this thing starts trading 151, it can go. So anyway, I just wanted to point that out to you. It illustrated 2 different things.
John, just as a point of clarity on the level. You were saying 150. We're at 189.
So the high on December 1st was 151.06, and then if you go back to the high on the December 3rd, let's see, no, excuse me, this thing just changed on me here. The 15th of November, 150.87. So 150.87 goes. Something's good. The odds are, and your bias must be to the long side.
We're on IWM, right?
IWM, yes, sir.
I mean, I'm looking at it on those dates, and I got 1.8. I'm in the 180s on what the days that you're referencing. The price action looks exactly what you're describing.
No,
So,
IWN. I'm
oh,
sorry.
N.
N.
Oh, okay.
N. That's okay.
Oh, that's fine.
IWM
Oh,
would.
okay, yeah, it's the same structure. It's all good. No worries.
Yeah,
We're good.
yeah, it's the same structure. Absolutely. Yeah, no, but thanks for making that clear. It's important. When you ever feel lack of clarity, it's a good thing just to kind of like back off and do nothing till clarity comes back to you. So the next chart that I had asked Taco to put up was MNST.
Yep, all
And
good.
so the first one, if you could, Taco, is put up the weekly.
Good.
Okay, so it's you have an obvious thrust there that happened in the last week of October, and then you've had just an absolute textbook consolidation. Bull flag, whatever you want to call it, and so this is going. This now tells me to tune in on the daily, and once again, it's very much like the IWN chart, in which you kind of have a series of highs that congregate over there to the right side, right around the 104, 70-ish area, 60-ish area, and you're about to move through that, and it doesn't matter whether this company is overvalued or undervalued. At this point, that it takes that out, that every single short in that market is underwater, and they're going to have to start covering. And so that's that. What really moves markets, guys, is not people being right; it's people being wrong, and that's a concept you got to get your head around, because what somebody could say, some analysts, well, MNST would be at 700 times earnings at 112. Yeah, but if you're short and you've got margin calls, voluntarily or involuntarily, they're going to take you out, and they're going to have to buy back that stock. So keep in mind, guys, this is a war. But this is a war not about people being right. This is about people being wrong. Because wrong money is scared. Right money is happy and probably out on the golf course.
I love that. That's quotable. Wrong money is scared.
No, it's again, just think of our we're humans. Think of our emotions. Use them. Fear is more powerful than being happy or being comfortable. So the next one, and this is just something that I'm looking at it, and I've traded it and I've posted it, and I still have about a 1/4 runner on it, but I'm certainly willing to reload more. Is PERI, and don't even, it's funny. We had a discussion in the room today, and it's like, I don't know what these companies do. And it doesn't matter. I'm not buying a company. I'm not, in whatever business. I'm a trader. So be clear to yourself that you're a trader, and that frankly, it's a pattern, it's a symbol, and you just don't give a fuck whether or not what they do, because all of a sudden now you're thinking too much. So this PERI, Perion Network, I guess it is. I don't know. See, I don't even know the name of the damn thing. I just looked at it for the first time. So I mean, this is a great pattern. And again, I use a 200-day moving average, a 50-day moving average, and a 10-day moving average, all simple. So it's above every moving average. The shorter term, based on your time frame, the shorter terms are above all the longer terms. This is obviously you're geared bullishly on this, and you've had one up thrust to start the year. You had a consolidation, and then you shot out of that. And I mean, that's when I got involved, a little above 30. And again, I like to take a pretty big slug of things and then scale it down to a quarter position and then let it ride. But you see how tight this consolidation is. Yesterday was an inside day, and then today was also an inside day. So if this directionally goes out through the top, you want to be involved on the long side. This is not one to think about on the short side. And that doesn't mean it's not going to go down. It's just, I'm just talking about how the odds are. Literally, I think one of my major edges is realizing that I, as a mere human being, do not have great predictive powers, but I do have very, very good observational powers. And we can all observe. Predicting, let's leave that to Hollywood and Kreskin. So that I just wanted to point that chart out to you. So Taco, that SBUX weekly that I talked about.
Yep, we're on it.
Okay, so just another simple one. If you just look at the year 2021 on a weekly, literally you can't help but see the head and shoulders. There it is. I mean, it's a classic head and shoulders. So this is just illustrative of, and I get some comments, and it's like, oh, the old patterns don't work. Well, I beg to differ, and I want you to see it, because I want everybody on this call and everybody in the room to succeed. I mean, that's my motivation. I'm not here to make anybody wrong. I want you guys to win. And so I'm just saying, if you were in Starbucks, which is what this is, okay, and after that right shoulder formed, and it got under the low of that shoulder, which was 104.02. If you're trading, I don't care what short term, how short term you're trading, 5-minute chart, 15-minute chart, 60-minute chart, daily, you've got massive powers working against you. I just want to sail in the breeze and put my sail up and let the wind take me where I need to go. I'm not going against the wind. And it's there is no such thing as, well, it's gone too low or it's gone too high. I mean, I saw this stuff, and again, I have an advantage in which literally 1 year soybeans are trading at $1.50, and the next year they're trading at $18 a bushel. And believe me, I was surrounded by people, when it got up to like $4. oh, soybeans are way too expensive now. So I'm saying that you just know your bias, but find your bias short term, which again, my perception is that most of you guys are trading short term. Literally do it, get aligned with the greater forces, and they will take care of you. Okay, Taco. The next one was a shop weekly.
You're all good.
Okay. So this just illustrates a pattern that I've seen, and I'll tell you how I play it, because if you took shop all the way to on a weekly to the week of November 15th, 2021, it's clearly in an uptrend. But this was a pattern that was taught to me by, a very successful, now long dead trader who, really took me under his wing when I was in the pits. And if you count on this weekly from the week of February 8th, 2021, there's one high. Then July 26th, 21, another high. And then that is November, the week of November 15th, 2021. You see how you have these three thrust up. Does everybody see that?
You betcha.
Okay. You betcha. That's a good word there. So I was taught, now you don't short the high. Don't get me wrong, but it actually sets up a short, because again, this guy was a fabulously successful, long-lived trader. He called those 3 anthills, and by the time you step on the 3rd anthill, because you just see how it makes a marginal new high each time. And this doesn't have to be on a weekly. This can be on a daily. It can be on any time frame. Basically, by the time you step on the 3rd anthill, you're going to start feeling the ants stinging you. So, when that thing went down, when it went down through that low of the week of October 4th, 2021. Now your anthills are confirmed, and your bias is now to short it. So patterns repeat and repeat and repeat and repeat. And now the interesting thing on this weekly, which when I sent these over to Taco, I really didn't observe it immediately. Shop, if you look at it now, kind of going back to last, I don't know, Marches or whatever, and then September into now, you pretty much have a confirmed inverse head and shoulders on the weekly. So, gun to my head, I'm trading shop from the long side. Okay, so another one that I had asked Taco to do is a weekly chart on Valero. VLO.
Yep, got it pulled up.
So if you just look at it since last June, it's built a classic rising wedge in which you start having higher lows and but then you had a lower high in November of last year, and so again, it's the same principle that there's no such thing as a triple top. Same thing exists in wedge-like patterns. The third time is the charm. It's going to go through that, and it's going to go through it with force. And it still has gone through it with force, even if you take the bad data out from 2 days ago. And something like Valero, and this is about as fundamental as I'll get on anything, is it's a long cycle commodity producer. So what I'm saying is that you just don't instantly bring on new refining capacity. If refiners are being pinched, it takes a while. So anyway, it's just something I wanted to point out to everybody. That's another example. So they don't, in order for three hits across the top, that can also be against a trend line. So anyway, those are all the pre-prepared ones. But ask questions, please, guys.
Yeah. Anybody have a question you'd like to ask?
Do you have like a general rule of thumb? Like, for example, if a ticker, so you use the 200, the 50, and the 10.
Yeah.
As long as it's above like the 200 and the 50, will you take it or will you consider it if it's like on a bounce off a 10?
It's a great
Because
question.
I sometimes struggle. Like I'll see like the 200. Let's say it's Valero and it's trading like $40 above the 200. I sometimes like struggle. Like it's way too far away. Like is the 10 kind of your
Yeah. First of all, I in my own personal trading, I want it to be above the 10, and preferably above the 10, which is also above the 200, which is also above the 50. If I get that set up, I'm interested, and I'm interested in size. But now today was actually a perfect touch of the 10 almost on the daily VLO. But I'm not a dip buyer. Now, what I do when I see that is I now zoom into a much shorter time frame. In order, because just because it goes down and touches a that 10, which is above everything else, that's not a buy in and of itself. So if you pull up a 5-minute bar chart, I'll tell you exactly where I got involved.
We're good.
Okay, so literally you had a close above. If you just take a simple 5-minute bar chart, and again, guys, I'm telling you, successful trading is super simple. Keep it simple. The more factors you have that you're considering, the more that can go wrong. So you have a bar that's yesterday, that closed at on my clock here at 10:25. It closed above the 10 simple moving average, and then it consolidated for like 6 bars sideways, and then it literally at 11 o'clock, that bar, it took that out. So when it exceeded that first high where it closed above the 10, I'm getting long. So this is how I use top-down analysis to get involved in something shorter term with the hope that I can keep a runner and the bigger time frame takes care of me. So that again, I want all the larger forces aligned with me, not against me. So in that case, I think my fills were, I don't know, kind of in the mid 144-ish, like between 30 and maybe, I don't know, 40 or 50 or 60. That one moved around a bit, and it took me a while. But that's where I got the position, and now I'm scaled. I've got a quarter scale. I'm down to a quarter. I've scaled 3/4. I've paid myself, and my stop is at my average entry now. I can't lose, except for the occasional massive gap down or something. But these are things that are outside of our control.
And
Hey,
if
John.
just a follow up, if you weren't able to scale out your 3/4, would your stop loss just be below your 10 SMA? Since that's the reason you got in.
No, that's a great question, by the way. My initial stop, if you see on that 5-minute chart, and I have to kind of do it in scales because of size, but nonetheless, just for a guy that's just getting going, my stop would have just been a little bit below that bar that occurred at 10:15 on the 26th, where the low was 41.10. So that would have been my initial stop on everything, or was. That's the point at which my team basically activates and starts working the order out. Fortunately, in this case, I got paid, and I got paid well, and I'm long a quarter, and I've literally journaled into my long-term accounts now, and my stops at break even, and who knows? Maybe I don't make any more. Maybe I lose all the way to cost on it, but on the other hand, maybe I have something that runs for 2 or 3 years. I've had that.
And that's the point, John, of the runner. We had a little bit of an exchange last night, some of us on one of the channels, and I explained that once you've scaled out, the point of your runner is that it doesn't always run the way we like it to, but it's those occasional runners that go so fast, so far, so long, that they more than make up for the runners that end up getting stopped out at break even.
Rich, that's 100%, and you don't have to lift a finger for that money to come to you. One ticker that I have you guys go and look back on, and this is in the late 90s that just paid and paid and paid and paid and paid, and it was worth way more trades than I could ever make an effort at. But if you go back to Qualcomm, like in 1999, early 2000, literally I was down to a 1/4 runner, and I literally even on that runner took well into the 7 figures off of that, just on the runner, because it just went crazy. So don't
Big run.
Yeah, the thing is that what I see, you know, because I see a lot of guys, and again, I want every one of us to win. You know, frankly, I see too much activity. You know, because you're you know, kind of philosophically, we can talk about techniques and et cetera, but the quality of your trades matters, not the frequency. And I just see too much frequency. And that's not a, you know, that's just a fact. It's not a criticism. I completely understand it, especially with newer traders, because, you know, letting the market do the work for you isn't that why you got involved in markets in the first place?
All right, I think we have one last question from Chris, John.
Okay.
I wrote that book over in the secret room last night, and you messaged me this afternoon to remind you to bring up those topics that I mentioned. Of course, it was lengthy, and I had submitted a question similar to the first session, and we just ran out of time. But it's a lot of topics. I'm trying to sync it because I know we don't have a lot of time, but you told you told the room a long time ago in the previous place that either you or Ed was famous for saying everybody gets what they want.
Yeah, Ed said that. Yes.
Okay. Well, what I've got, I really don't want, and the gist of the writing was when you are just absolutely beaten. And you covered some of it with your first question today, your first answer about, you know, rebounding, coming back. You were answering Dan, but how do you handle that emotion when everything goes wrong? And I don't know if you remember the little exchange we had today.
Now, Chris,
you told me that.
I remember.
You told me many traders are going through what I'm going through. They just won't admit it, or they won't ask for help, or they won't say it. And so you thought you could reach some other people. And anyway, that's the topic. I don't have a specific question. I've got 20 questions, you know.
Hey, Chris, first of all, I mean, DM me anytime with all, and over time I'll answer them all. I mean, again, I want you to win, and I hear what you're saying, and it's really important. And
I'm gonna mute and listen now. Okay.
Okay. So, I mean, what Chris brings up here is something that it happens to every trader. I mean, you know, one of the great traders that was in the orbit that Ed and I were in was a guy named Michael Marcus. And Michael is one of the most intense guys you'll ever know. I mean, that guy just had a photographic memory of every chart there ever was of any commodity. Just insane. I mean, you could bring up something and say, what do you think that looks like? And he goes, oh, I think that looks like December corn in 1953. I mean, literally, that's how intense the guy is. And, you know, and Mike ended up being a very successful trader, but he had, you know, some serious blowups. And I mean, you know, you know, and Mike, you know, literally just got so disparaged, and so dispirited that he, I mean, he went and you know, got on. He was at the same time taking uppers and downers. Uh, yeah, that's the idea. I can focus and relax at the same time. And, he tried everything, and the only thing that worked for Michael, and the only thing that worked for me, and the same I'll vouch for Ed, is, literally, when you're in a slump, back off, and in fact, it might be good just hearing your words to disengage for a while, study the markets objectively, and come back with whatever approach suggests itself to you after your observational period there, where you're detached. Because if you're in the market, I mean, the markets are a very emotional place. I mean, making and losing money is very emotional. And so first of all, you've got to just back off and, God, I forget who said this, but there was some guru back in the day said, and give yourself a checkup from the neck up, whatever that means, if to you, in terms of, I mean, for Ed, it was taking massive hits of acid and mushrooms. I may or may not have participated in a few of those, but time, literally, as I would describe it, time out of mind, and in effect, get out of your own way for a while, and then reevaluate and then reengage. There's again, let's go back to